All right, today we're tearing down the initial public offering of Narmadesh Brass Industries. We're going to dive deep into their official documents, their prospectus, to figure out one simple thing. Is this a golden opportunity or just a brass trap?
So let me ask you this. You're looking at a company, and its profits suddenly go through the roof, right at the exact moment they're asking you for your hard-earned money. What do you think? Is that a rocket ship you should jump on? Or is something about to blow up on the launch pad? Well, that's the central question we're going to answer today.
Okay, first things first. Let's look at the story Narmadesh Brass is telling us. Every single IPO has a narrative, right? A big, shiny vision of the future that they want investors to buy into.
So what does this company actually do? Well, on paper, it's pretty straightforward. They're a manufacturing company based out of Gujarat, India. They take raw materials, think scrap brass, zinc, copper, and they turn them into things like plumbing parts, sanitary fittings, brass rods. You get the picture. It's a very industrial, nuts and bolts type of business.
And this slide really shows you their whole business model in a nutshell. On the left, you've got the raw material, these brass billets. And on the right, you see one of the finished products, a brass ball valve. So they're taking basic metals and turning them into components with a higher value that are used in all kinds of different industries.
So, why the IPO? Why are they going public? Well, according to the prospectus, the plan sounds pretty standard. They want money to buy new machines to expand. They need funds to cover their day-to-day operating costs. That's what working capital is. And then there's the usual catch-all, general corporate purposes. It's the classic growth story. Give us your money, and we promise we'll get bigger.
Okay, so that's the story. It sounds reasonable enough. But now, we're going to do our real job as analysts. We have to look past the pretty narrative and go straight to the numbers. And these aren't our numbers. These are the numbers from their very same document. Let's see what kind of reality they reveal. Whoa, okay, take a look at their earnings per share. So for the year ending in March 2023, it was about 4 rupees. A year later, it jumps to over 15. And then in the year ending March 2025, right before this IPO, it more than doubles to over 32. I mean, that is just a massive, massive spike in profits right when they need to look their absolute best. And then notice how it drops off in the latest half-year data. That really makes you wonder how sustainable any of this is. And if you thought that was wild, get a load of this. Their return on net worth. Now, think of this number as a report card on how well they use shareholder money to make more money. In 2023, it's a decent 10.77%. But then look at 2024, it explodes to a frankly ridiculous 123.94%. Then, just as quickly, it crashes back down to around 50%. You know, this kind of volatility is a huge red flag. A return of over 120% is not just unsustainable, it's the kind of number that screams, look closer. You know, there's actually a term for this in finance. When a company's performance suddenly looks incredible right before an IPO, it's called IPO window dressing. It's basically the practice of sprucing up the financial statements to look as attractive as possible to potential investors. And the big question you have to ask is, are we looking at real, sustainable growth here, or is this just a fresh coat of paint? So, the financials, they're raising some serious eyebrows. Let's shift gears and look at the business itself. Does Narmadesh Brass have what we call a moat, a real defensible competitive advantage, or is it all just a myth? So on the left, you see what they claim are their strengths. On the right is the reality check we get from digging into their own prospectus. They talk about expanding, but the reality is this is a commodity business. They're making brass parts, not some unique patented technology. They claim a diverse product range, but their own holding company, Spray King Limited, is in the exact same business. That creates a massive potential conflict of interest. And sure, they have experienced promoters, but the business is also completely reliant on them, which is a classic key person risk. And this diagram of their manufacturing process just proves the point. Look at it. Scrap selection, melting, casting, extrusion. There is nothing special or proprietary here. This isn't some high-tech secret sauce operation that no one else can figure out. This is a standard process that literally any competitor can copy. And that means they're probably competing on price, not on unique value. That moat, it's looking pretty shallow. All right, now for my favorite part of any prospectus, the fine print. This is the section most people just skip over. But trust me, this is where the most important clues are usually hidden. Let's talk about the governance red flags. And boy, is this list concerning. First off, they changed their auditor in January of 2025, right before kicking off the IPO. That is a classic textbook red flag. You have to ask, why the sudden change? Next, the company admits to past delays in paying its legal dues, things like taxes and employee retirement funds. That can point to poor financial discipline. Third, their trademark isn't even registered. That's just basic legal housekeeping. And finally, they have significant business deals with related parties, which always opens the door to the possibility that the company isn't getting a fair deal.
And if you need any more convincing, just listen to this. This is a direct quote from their own risk factor section. There is no guarantee that our promoter companies will not compete with our existing business. They are literally telling you in black and white that the people running this company through their other companies could end up being your direct competitors. I mean, that is a staggering admission of a conflict of interest. So, let's put all these pieces together. We've got a really suspicious spike in profits right before the IPO. We've got an unsustainable return on net worth. We've got a business with a very weak competitive moat. And we've got a whole list of serious governance red flags. So what does this all mean for you, the retail investor? Let's be crystal clear here about who should avoid this IPO. If you're a safe, conservative investor, stay away. If you're a moderate, risk-averse investor, stay away. If you are looking to build long-term wealth by investing in companies with solid, stable fundamentals, stay away. The only person who might even think about touching this is a high-risk, aggressive trader who completely understands the enormous risks they're taking on. So, our final verdict, based purely on the facts presented in their own document, is a single, simple, and very clear word: avoid. And the reason is simple. The numbers look like they were engineered specifically for this IPO. The business itself has no clear defensible advantage. And the governance practices, from changing auditors to the blatant conflicts of interest, just raise way too many questions. This is a very high-risk offering that appears to be built on a very weak foundation. And that really leaves us with one final crucial thought for you. Every IPO tells two different stories. There's the polished, exciting marketing pitch you see up front, and then there's the unfiltered truth that's buried deep in the financial tables and the risk factors. So the real question is, when it's your money on the line, which story are you going to choose to believe?